What's up everybody, I'm Adrian Thompson and welcome back to my channel. So I actually started this channel because I wanted to force myself to learn and document my financial journey coming out of poverty. And one of the easiest ways to climb out of poverty and to create generational wealth is actually through retirement funds. So that's why this video and the next video I put out are going to be about retirement funds, and this one specifically is going to be about 401ks. Also, if you guys notice these crutches in the background, I just had ACL surgery, so if you guys appreciate the dedication that I have for putting these videos out, please go ahead and smash that like button. I think my doctor said that it'll make my knee heal faster, but I guess we're gonna have to wait and see. So first things first, I think it's best to quickly explain the concept behind of a retirement fund or a nest egg. So essentially, you wanna gather up so much money into investments in stocks and bonds and whatnot to get an average of 7% return on the year, and you live off of that return that you made on your large sum of investments. Now, obviously, the retired version of you ideally wouldn't have to work and wouldn't have a job. So you actually don't want to live off of 7% of the investment. You want to live off of 4%. Most analysts say 4%, and it's shifting to 5%. That way you leave a little bit of percentage left in your growth to account for inflation. So for example, and also for easy numbers, let's say your retirement accounts all added up to $1 million. So if you got an average of 7% return on that $1 million, you would get $70,000 of growth. And you would try to live off of $40,000 to $50,000 and have that pot increase by $20,000 to $30,000 with the remaining money you didn't touch. Now, if you do this conceptually and usually in practice, you'll never actually touch that original nest egg of $1 million. Even though some years you might lose money, some years you might gain a lot of money, more than 7%, maybe 10, 12, or 13. Since you're only living off of 4 to 5% of the actual growth, you never should touch that $1 million nest egg. Now that is a very simplified version of what retirement is, and it can get more complicated for that, but for the purpose of this video, conceptually, that's good to understand. So in general, there's a lot of retirement accounts, but there's two main accounts that you will see pop up again and again, and there's two types of each of those accounts that you will also see pop up again and again. So the two main accounts that you're gonna come across in terms of retirement will be a 401k and then an individual retirement account, or IRA. And each of these accounts have two different tax types. That's either a traditional or a Roth. So to put it simply, a traditional retirement account is when you put in untaxed money, let it grow without taxes, and you pay taxes at the time that you pull the money out. And then a Roth retirement account is actually the exact opposite. You will put money in that you have already paid taxes on, so when you do pull it out later on in retirement, you don't actually pay taxes on the capital gains. Like I said before, in today's video, I'm going to focus specifically on what a 401k is. But don't worry, next week I'm going to make a video on IRAs and comparing the two. So I know what you're probably thinking, why the hell would anybody call a retirement account a 401k? What does that even mean? Well, it's actually named after section 401 subsection K of the IRS tax code. And that basically just explains that employers can sponsor a retirement account, and explains how those accounts are taxed and limited. The reason why 401ks exist was that the government realized that most people weren't saving money for retirement, so this way they could influence you in one way or another by giving you such benefits to start saving for retirements, because they make it dumb not to do so. And companies went along with this because if they do have a 401k and it's a good one, it's another way to get better hires into your door and get higher quality employees. So when you make a 401k account, the first thing you have to decide is whether or not you're going to do a traditional or a Roth 401k. To be honest with you, Roth 401ks are pretty rare, and some companies don't even offer them. So when people say 401ks, typically what they're referring to is a traditional 401k. Then you have to decide what percentage of your income do you want to put behind for retirement. So for easy numbers, once again, I know this is a large salary for some. Let's say you make $100,000 a year and you decide to put 10% of your income into your 401k. At the end of the year, after you've collected all of your paychecks, your 401k will have $10,000 in it, but your taxable income would only be $90,000. So you'd be taxed as if you're only making $90,000, and then you would have $10,000 in a completely separate account, not taxed yet. But keep in mind though that the government set this up to incentivize you to save for retirement. So what that means is if you do decide to pull money out before you retire, you're probably gonna have to pay taxes on it, and most likely you're gonna have to pay a 10% penalty fee for pulling this money out. It should not be treated just like another savings account. That's why it's a good idea to understand how much money you need to live for your day-to-day life. So you're not putting too much money into your 401k to where you're restricting your day-to-day life, but you're putting enough money into your retirement that will be able to sustain you once you do stop working into your 60s. Now, there are some exceptions to this rule. If you have a large medical expense, and sometimes if you have to pay for a college, they will let you use this money without the penalty. Typically, it's not a problem of people dipping into their retirements. I just wanted to mention it in this video so you don't walk away thinking, oh, I'm going to throw all of my money into a 401k. I wanted to do an experiment to show you guys the difference between a Roth 401k and a traditional 401k. So what I did was I acted as if me as a 25-year-old put $10,000 in today. How much money would that be? And how much money would I be able to take home if I cashed it out when I was 60 years old? So first things first, if it's a traditional 401k, I can just put $10,000 of untaxed money into that account. But if I wanted to do a Roth IRA and put $10,000 in, I'm gonna need $14,492 after taxes in order to put that money into account, meaning I have that amount of money, it gets taxed, and then I have $10,000 in my bank account that I can then transfer into my 401k. So even though it cost me more by roughly $4,000 to $5,000 for the Roth IRA account to start with that $10,000, both of the accounts, because it's the same interest rates, are going to end up at, I'm going to refer to my screen because these are large numbers, $106,765. Like I said, that's compound interest for you. Go see last week's video. But keep in mind though that the traditional account, even though it's at $106,000, I didn't pay taxes on it yet. So let's say I would have cashed out the entire $106,000 pot. That's not how you would do it, but it just goes to show what I'm trying to exemplify here. If I went and cashed out the whole $106,000, I would have to pay income taxes on all of that money. If I'm assuming that taxes are the same rate in 35 years as they are today, and they'll probably be higher to be honest with you, but if I assume the same rates, I will only take home roughly $74,256 of that original 106. I guess that's not rough. I guess that's very specific down to the dollar. But keep in mind the Roth account, I don't have to pay taxes if I cash the whole thing out because I already pay taxes when I put that money in for it to grow. So that's a whopping difference of $32,509. And remember, the beginning difference was only roughly $4,000 to $5,000. I know what you're thinking, why would anybody do a traditional 401k over a Roth 401k? But keep in mind that this is a very exaggerated example. So the average American only makes roughly $40,000 a year, so they don't have a lot of money to put into their retirement account of post-tax money. So it's easier for them to put in pre-tax money and still have enough money of their tax money to live their day-to-day life. And keep in mind, we technically put more money into the Roth example over the traditional example. To prove my point, if I would have taken that $10,000, let it get taxed at today's rate, I would come out with, let me see here, $6,955. And if I invested that amount and let it grow at the same rate as the $10,000 in the previous example, then we would come out to $74,256 in 35 years. Now that's actually the exact same amount, assuming that taxes are the same, of the traditional account that got taxed later on. So what does all of this mean? So in practice, if you think you're going to be in a higher tax bracket when you're older, you want to use a Roth 401k. And if you think you're going to be in a lower tax bracket when you're older, which you might be since you're not working, you want to use a traditional IRA. That way, the money you put in, you are trying to get it taxed whenever taxes are lower in your relative life. Now, the last major point that I want to talk about a 401k and what makes it different from an IRA is that 401ks can have an employee match. So a 401k actually has the option for the company that you work for to put in money into your retirement account absolutely for free. And that's right, I literally mean for free. The way it usually is worded and what it will look like is it'll be something like a full percent up to 3% or 0.5% up to 8%. So let's say you work for company A and you make $100,000 a year and your company matches a full percent up until 4%. If you put in $4,000, your company will match that and give you $4,000 at the end of the year. But if you put in $5,000, since there's a cap at 4% of your annual pay, they will still only give you $4,000 a year. Now, there are 3 quick points I just want to bring to your attention before we leave this video. One of them being that there is actually a cap of how much money you can put into your 401k. The number fluctuates, so for this year in 2021, the number is $19,500. But if you're older, sometimes they raise that amount, but it's always good to check with a professional and making sure that you're putting in as much money as you're allowed to put in. The other thing is there's something called a vestation period or a vested period, and what that word means, what vested means, is ownership. So like I said before, if company A decided to give you $4,000 of a match, it might show in your account that you have, let's say you put $4,000 in, you have $8,000 total, but only $4,000 vested. And that is because the company hasn't actually given you that $4,000 match yet. Usually this means like you have to work at the company for 2 years, and after 2 years, you'll see all of that potential money directly put into your account. I just wanted to bring that up because the vested amount of money that you have in your retirement account is actually how much money you have in your account today if you leave the company. Lastly, 401ks are just a conglomeration of stocks and bonds and different investments, and are typically handled by Vanguard, Fidelity, or any of the big companies. And since they usually handle your 401ks and is working with your employer as well, there's usually higher fees when compared to an IRA. The fees aren't enough to make or break your retirement. Usually I have heard of some cases, but it's just something to keep in mind. You can, depending on your company, actually handle your 401k completely on your own, but not every company will offer that. Lastly, to close, I'm gonna steal this from Graham Stephan. Time in the market is significantly more important than timing the market. So go ahead and get your retirement account started as early as possible so compound interest can work in your favor. I hope that helped, and remember, if you like this video, go ahead and hit that subscribe button. It'll help my knee out. And remember, it may be hard now, but it doesn't always have to be. I'll see you in the next one.